It is said that a rising tide lifts all boats while a receding tide leaves them stranded. But what if some of those boats are leaking, their sails are torn, and they're headed straight into a storm? Earnings growth are the sails to your investment boat, and if earnings start to go south, the chances of a shipwreck are significant. Enough of the boating parlance. Let's get back to the topic of this video. We're diving deep into 4 sectors that, despite this bull market, are flashing warning signs you just can't ignore. You see, not all that glitters is gold, and in the stock market sometimes what everyone's chasing is about to lose its shine. Now, I've always said that understanding where the economy is going is crucial for smart investing. And right now, there's a sector that's tightly intertwined with the health of the Indian economy, particularly in rural areas: microfinance. For years, microfinance institutions were the darlings of the market. They provided a lifeline to those who needed it most, and investors reaped the rewards. But things have changed. The reality on the ground is far from rosy. Unsecured lending, a hallmark of microfinance, is coming back to bite. We've seen a relaxation in rural stress which initially seemed positive. However, it's led to over-leveraging. Institutions flush with cash went on a lending spree, often to those who could least afford it. This has caused a surge in NPAs, those dreaded non-performing assets, essentially loans that aren't being repaid. And it gets worse. The competition in this space is cutthroat. Everyone's vying for a piece of the pie, pushing institutions to take on even riskier loans just to stay afloat. This isn't a blip, guys. It's a deep, cyclical downturn, and trust me, we are far from the bottom. Remember those market darlings I mentioned? Companies like Fusion and Satin Credit Care? Well, their share prices have been hammered, and it's a sign of things to come. There's a saying in investing: beware of crowded trades. When everyone and their neighbor is piling into a sector, it's usually a sign that the easy money has already been made. And right now, the paint sector is looking awfully crowded. I recently reread Edward Chancellor's brilliant book, Capital Returns. He talks about how high capital expenditure and a sudden influx of players in a sector are recipes for disaster when it comes to investor returns. Sound familiar? That's the paints industry in a nutshell. Asian Paints, the undisputed king, is facing an all-out assault. New entrants like Birla Opus and JSW Paints are coming in hot, slashing prices and eating into everyone's margins. We're talking about a full-blown price war here. And the thing about price wars is that there are rarely any winners, especially in the long run. Now, you might be tempted to see this dip as a buying opportunity. But remember, catching a falling knife can leave you badly hurt. This isn't the time to be a hero. Until we see some consolidation and a return to rational pricing, your portfolio might end up with a fresh coat of red paint if you try to bottom fish here. Now, the FMCG sector, those consumer staples we all know and use, has always been considered a safe haven. These are the companies that make the things we need day in and day out. But even giants can stumble. One word: rural distress. It's real, and it's hitting the FMCG sector where it hurts. A significant portion of India's population lives in rural areas, and their spending power has been severely impacted. This has resulted in negative to flat growth for many FMCG companies. And it's not just about rural distress. There's a new wave of competition from smaller, nimbler brands. These brands are often seen as healthier, more ethical, or more aligned with the values of today's conscious consumer. Now, I'm not saying companies like HUL and ITC are going anywhere. They're behemoths with incredible brand recognition and distribution networks. But here's the catch: their valuations already reflect this dominance. They're priced to perfection, leaving very little room for error or even moderate growth. In the short to medium term, be prepared for muted, if not disappointing, returns. For years, the Indian IT sector has been a beacon of growth, a testament to the country's technological prowess. But the winds of change are blowing, and even this giant might be caught off guard. Artificial intelligence, or AI, is no longer a futuristic fantasy. It's here, it's evolving at an unprecedented pace, and it has the potential to disrupt the very foundation of the IT industry. And it's not just AI that's keeping IT leaders up at night. Consumer spending in the US, a major market for Indian IT companies, remains subdued amidst high interest rates. This directly impacts their bottom line. Then there's the ongoing challenge of attrition. The demand for skilled tech workers is sky-high, leading to high turnover rates and driving up operating costs for these companies. Even those segments within IT that were considered relatively immune, like ER&D, are showing signs of slowing down. Companies like K-Pit, a major player in this space, have cut their guidance, sending ripples of concern throughout the industry. The Indian IT sector is at a crossroads. An important point to note is that this video might not be useful for value investors with longer investing horizons. The information I've shared today isn't meant to scare you off, but to empower you. Take this video as a starting point of your research. Do your due diligence and keep learning. Until next time, happy investing.